Hey, hi, this is Kribakaran Rajendran, founder of algo trading firm squareofbots.com. So in this video, I'm going to talk about some of the common mistakes that most people who get started with algo trading do. Compared to 5 or 10 years before, doing algo trading takes a lot of time and effort, and also you need to have a lot of tools to automate your trades. But now algo trading is completely easy, where people who do not know about coding can easily use any kind of no code platforms and automate their trades. So since the process of automating the trades, or since the process of getting into algo trading has become a lot more simpler, the number of people who start doing algo trading has increased phenomenally. And especially after COVID and after these work from home cultures, people who wanted to try algo trading are much higher. So the thing is, once people start getting algo trading, so earlier the overall phases, like people will do discretionary trading, they'll do manual trading for a couple of years, they monitor the markets, they'll observe the market behavior, and whatever things that worked for them, they try to automate it, and then they finally get started with algo trading. So now what happens is, because of the ease of these platforms, because of free APIs and because of no code platforms, most people directly get started with algo trading. So they try to do, and 90% of the people are option traders. Because of the introduction of weekly options, and because more and more people are talking about options trading, people directly got into options trading. Earlier, people will start with stocks first, and then they'll do it with positional trading, and then they'll do with the intraday stocks, and then they'll start doing futures trading, and then finally they'll get started with options trading. But now people ignore all the steps and directly they get started with options trading. So if you're an algo trader, or if you're a trader who's getting started with algo trading recently and you are facing a couple of issues, then this video would definitely help you out to overcome all those issues. So the first mistake that most algo traders do is, once they see a strategy in the internet or in a workshop or in a seminar, they see, they get excited with all those backtest results, and then they directly put all their capital into that specific strategy. So they would have tried multiple things and it would have not worked for them, and suddenly when they see something which is really doing well in the backtest reports, or whichever the strategy that they are learning in the internet, and if they see it is really good, and if they are excited about it, they'll think, okay, whatever the strategy that I'm currently running is not really as good as this one, so probably let me stop the one which I'm currently running and start doing this new one. So what they'll do, they'll deploy all their capital with this new strategy. But the problem is, you are just seeing the end point. Okay, this is where you start with 1 lakh and you end with 10 lakhs in 2 years, and this is how much the returns has been generated in the backtest. So by deploying all my capital, I could double my capital in just 2 years, because that is what this new strategy states. But the problem is, once you directly jump into a specific strategy, it will be really hard for you to stick to that strategy. So just because of some strategy results are really good, don't directly jump in with all your capital. So first, test the waters. Just try it out with just one lot first, no matter whatever your capital is. I always say this wherever I go and whomever I talk to, always test with one lot at least for 100 days, so that you will get used to the overall strategy fluctuations. Like if the market goes up, or if the market goes down, or if it stays in sideways, or if it moves in zigzag, how your overall MTM will fluctuate with these different types of markets. So this will give you an idea. Okay, this is how the market behaves, and so obviously this is how the strategy works, and I would be then this will give you a conviction to stick to the strategy over the longer period of time. But when you directly trade with a higher capital, the moment you see 3 or 4 losing streaks, you tend to doubt the strategy. You will not have conviction to stick to the same system, and you will not have the willingness to take that fifth trade after continuous losing 4 trades. So it is wise to start with the lower capital or with just one lot and trade it for complete period of 100 days. So this will give you an idea, okay, this is how the strategy works, and then you slowly scale it up from 1 lot to 3 lots, and then 3 to 5 and 5 to 10. Slowly when you scale it up, then the chances of sticking to the strategy is much higher. So always remember, more than the overall profits and everything, it is all about whether you are able to be a disciplined trader or not, and that discipline will come only when you have a conviction in a trading strategy. And once you have a conviction in a trading strategy, you will stick to the system, and once you stick to the system, everything will fall in place, because you will eventually become a disciplined trader. And second thing is, most algo traders who are getting started recently, they are giving so much preference to free brokerage brokers, like brokers like Finvasia and other brokers. They are giving no free brokerage, and it is good, where you could control your overall transaction cost. But also you need to examine whether these platforms are really robust enough. Are they giving you the platforms which is completely error free? So I've observed a couple of issues in the past with all these platforms who provide free brokerage. So there could be frequent downtime issues, there could be issues with the APIs, there could be issues, orders not getting passed through. So all these issues will always be there. So when you choose a broker, specifically if you're an algo trader, don't think too much about the brokerage. Instead, start exploring their API. Read more about their API or check what other users are talking about these brokers, about their API. So because with respect to algo trading, the main thing is as long as there are no error-free execution, then there is a high chance that you could replicate your live results with respect to your backtest results. But if the broker is giving you frequent issues, then if you're not able to get the exact results from their trades, obviously it is not going to match with your backtest results, and it is going to totally deviate the overall results. So the first thing is, don't give too much importance with respect to brokerage, because initially, if you're trading with one lot or two lot, this brokerage transaction cost on a percentage basis could be much, a bit higher. But once you increase your lot size from 3 lots, 5 lots, 10 lots or 15 lots, this brokerage doesn't matter, because no matter whether you trade with one lot or 100 lots, your brokerage is going to be constant. So if you are trading with higher lot size, don't give too much importance about brokerage, because more than the brokerage or more than these type of free brokerage plans, the more robust the API is, the better the chance of error-free execution. And one more thing is, when you are backtesting any kind of strategies, what I have observed personally is, whenever I backtest with a strategy like shorting in the money, short straddle or short strangle, like instead of shorting at the money call option, at the money put option, if I'm shorting in the money call options or in the money put options, then the premiums are higher. So obviously, the backtest results will give me great results compared to at the money or OTM options. So people tend to think, okay, my backtest results has given me a huge returns because I have tested with in the money options. But once you start deploying that in the live markets, then your result might deviate much, because in the money options premium are much higher. And when you deploy it in live, the slippages can also be much higher with respect to in the money, because the liquidity wise, in the money might not be as liquid as at the money options or OTM options. So when you see a good backtest results, don't get excited. It could be because of these things. Like when you include in the money options in your backtest in a basket, then probably your returns could be much higher. But you can't expect the same kind of results in live markets, because in the money might give you higher slippages. So you need to keep that in mind when you are designing a trading strategy with respect to in the money options. When you test any specific strategy with a very small stop loss, I could see many people using 5% stop loss, 8% stop loss, 10% stop loss. So when they use these kind of very minimal stop losses, their overall return to drawdown ratio goes much higher. Like there will be very minimal drawdown but big returns, and overall maximum drawdown will be very less, losing streaks will be very less, maximum loss will be very less. It is because in the backtest they have used a very minimal stop losses. When you use these minimal stop losses, it can definitely give you a great backtest results, but we can't again expect the same thing in live markets, because when you use these kind of minimal stop losses, Bank Nifty or Nifty, whatever the indexes is, these options premium could drastically move within few seconds or few minutes. So when you use small stop loss like 5% or 10%, in the system you might use a 10% stop loss, but by the time it moves up suddenly and then hits your stop loss, the point which it gets filled must be much higher. It might not get filled at 5% or 10%. Instead, it would have got filled at 15% or 20%. So with each and every time the stop loss getting hit, your slippages will be much higher. So obviously, again, this is going to deviate from your backtest results, because in backtest, you have used a very small stop loss, but in live, if you use a very small stop loss, it might not give you a great results. So you have to keep that in mind when you're designing a trading strategy. Trading one lot versus trading 100 lots. If you compare it, the overall cost wise, the number of points that you need for a break even is much higher when you trade with a lower lot size. But the number of points that you really need for a break even is much lesser when you trade with a higher lot size, because the overall transaction cost with respect to percentage basis goes down drastically. And most important thing is option buying strategy. So these kind of option buying strategy, I have seen people using, say for an example, if option premium increases 15% or 20%, go buy this option. Or if option premium increases 30% or 10%, whatever, if there is a X percentage of increase in option premium, just buy that option with 10% stop loss or 20% stop loss. So what they specifically targeting here is they're looking for a specific momentum in options premium. So if there is an increase in option premium, they tend to think, okay, the option is going in this direction. So if there is an increase in CE premium, they think market is going up, so let me buy this option. If they see an increase in option premium in put option, they think market is going down, so let's buy a put option with a small stop loss. So this works as long as market moves in one-sided direction. But with respect to these kind of strategies, the problem is, yes, you could make higher returns, but you will be in the underwater for a prolonged period of time. You might see back-to-back high number of losing streaks, and you would not be able to see, you would be able to be underwater for a long period of time. Like it might not give you no profits at all for months, for weeks together. But these kind of strategies, instead of trading it as a standalone option buying strategy, if you mix it with any kind of option selling strategy, then chances of survival is much higher, because consistently with option selling you would be able to make money, and this option buying losses that you get from option buying will be very minimal, which can be offset using the option selling strategy. So if you're designing an option buying strategy, instead of just directly focusing on increase in option premium and then trying to get into it, try to add some other logic towards it. Try to add some other logic based on market behavior. Like I could see many people, and there are few people who also use basic market characteristic structure, like pivots, swing high, swing low, break of swing highs, break of swing low. So these are normal market behavior patterns. So when there is a breakout on those important levels, they get in. With these kind of strategies, which is built based on market behavior, the trades will not be triggered every single day. So they will not just enter whenever there is an increase in premium or whenever there is a decrease in premium. Instead, they are relying on market data. Instead, they are relying on market behavior, and accordingly, whenever it gives you a trigger, then they get into it. So just that is how our golden ratio option buying bot is designed. It will not trigger every trades. It will not trigger trades every single day. Instead, what would happen is, whenever there is a breakout, it will trigger. Otherwise, it would not trigger, and these breakouts will happen once in a while. So obviously, only 6 or 7 trades will be triggered in a month. So whenever there is a big trending move, it tries to get into it, and whenever market stays in sideways, there will not be no triggers. So if you design an option buying strategy based on these type of market behavior, then the number of trades will be less, and the number of times that it's going to be under drawdown is also less, and overall returns to drawdown ratio will also be much higher. Instead of directly going on percentage increase in premium, if you design an option buying strategy based on market behavior, then that would help in the long run. Running one strategy versus running multiple strategy. Because running one strategy will always go into different, when market goes into different regimes, like it can be in a completely highly volatile period, moving ups and downs for one period of time, and again it can be in trending one period of time. So when you run only one strategy, it might really do well at one phase, the other phase it might not do well. But when you're diversifying with multiple uncorrelated strategies, then it is not going to make positive returns every single day, but the number of days that it is going to be underwater will be very minimal. So by diversifying with multiple uncorrelated strategies, you would be able to sail through these kind of different market phases, whether it's highly volatile or low volatile, highly trending or non-trending. When you mix couple of strategies together and then if you trade it, it would be much easier for you to sail through these rough phases easily. So that is why many traders are currently diversifying with multiple strategies, which is really a good thing. So if you're a trader who is just sticking to one strategy, try to diversify with multiple strategies, which might be really helpful for you to sail through rough phases easily. Since we traders trade every single day, we wanted to check how the strategy has performed on every single day basis. We keep track of it, we keep journal of it, and know when there is back-to-back losing streaks or whenever days where it doesn't make any profits, we feel down. Like we go and check in Twitter, we go and check in other platforms whether I lost money, whether the other traders also lost money, and as long as the other traders are losing money, we'll be happy. If we are losing money and if the other traders are making money, then we'll be really feel sad. The problem is each of these strategies are totally different from one another. So if you focus on your strategies versus other people's strategy, you will always have this constant regrets. So don't really bother about what the profits and loss of other people's strategies. Just completely ignore about it. And second thing, don't try to focus too much on daily P&L analysis. Just ignore it. If you just zoom and see, like check out your overall backtest results, whatever the strategy that you have tested it. If you check the daily P&L, if it is a profitable day, just mark it as green day. If it is no loss making day, just mark it as a red day. So once you observe these color patterns, then you will see there will be a lot of red colors, there will be a lot of green colors equally, because more number of days will be losses, more number of days will be profits. But just convert that into a daily P&L, into a weekly P&L or a monthly P&L. Now if you see, the number of profitable months will be much higher compared to number of profitable days, because you're just zooming out and seeing, and you're seeing, okay, monthly basis only few months are in loss. And then from month, if you just move to yearly basis, then you will see all the years are profitable years. Because on the long run, that is what we really need. We don't really need to be profitable every single day to make money in the long run. Whether we are able to make money by the end of the year, by the no, at least by half a year, but at least by quarterly, without much deviation. That is all we want. So don't give too much importance about the daily panel. It will always be fluctuating. It will always give you so much of pressure when you track the daily panel. So just journal it, but don't give too much importance about daily panel. Just zoom out and check. You will obviously be much more happier by seeing the overall large data sets. I think I've shared this incident in other events wherever I go. So this is a personal event which I could really connect with. So this happened in 2019 when I went to a CMT event organized in Mumbai, where traders across the world came into that event to speak about their overall trading journey. So in that event, I was able to interact with one of the top traders in the world. His name is Tony Saliba. And this person is actually featured in the book called Market Wizards by Jack Swagger. So if you read this book, then you will know about him. And this book, Market Wizards by Jack Swagger, is nothing but a collection of interviews of top traders across the world during this. It was published in 1980s and 1990s itself, where he himself went and interviewed all these top traders, and he has published that in a book. And if you read this book, you will know each and every trader has a different set of approach towards markets. Like one will say technical analysis works, one will say fundamental analysis will work. So each of them has their own perspective, and each of them follow their own trading strategy, and everybody are successful. So there is no one single route to be successful. So if a person A is following certain thing, it is not necessary that you need to follow only that person A. Like whatever things that is really suitable for you, you can take that from person A and then follow it. So that is what I learned from this book. So this person, Tony Saliba, is an option trader. So I met him, and then I asked him this one question, like, okay, you are currently one of a successful trader managing millions of dollars. But if there is one incident in your overall trading career which completely changed or transformed your overall career, what that incident would be? So when he started trading during his early years, whatever the analysis that he did was really well. Even people who followed his analysis, they were also able to make money. But this guy was not able to make money with his own analysis. So what he said is, whenever I try to do the analysis and make a trades based on my analysis, and market used to go in my favor, and suddenly it goes against me. And whenever it goes against me, suddenly I book loss and come out. But people who are following me, they will not do that. They'll just stick to that, and they'll eventually, my analysis will be right. They'll able to make money. But I was not able to make money because I was not having the conviction to stick to the trading plan which I have devised. So over the years, what he has observed is his analysis is right, but the problem is he did not know how much is too much. He was trading with a higher capital which he can't afford to lose. This is playing a psychological, emotional barrier to him in being a disciplined trader. So he decided one day that he is going to be a one lot trader. Like he is going to follow just only one lot. He is just going to execute only one lot for next 1 year completely. So no matter how many millions of dollars that he has in his account, he is just going to follow only one lot. For the next 1 year, he completely stick to the same plan of just placing only one trade for the next 1 year, because he said that he was not really in a hurry to become rich. He just wanted to follow a process, and he just wanted to become a disciplined trader. And once he achieves that state, obviously it is very easy for him to scale up the capital and become profitable in the long run. And then he followed this approach of executing just one lot every single day. So he'll come to the trading pit and he'll just observe the markets, and he just plays one lot, and he'll not be least bothered about the outcome, because that one lot is not going to affect him anyway. But he wanted to know whether his analysis is right, whether he is able to stick to the same system irrespective of the market behavior. So the next 1 year, he was able to stick to the system. He eventually became a disciplined trader, and also majorly it increased his overall conviction in his own trading system. And from then onwards, he slowly started increasing your overall trading capital and overall trading lot sizes, and eventually now he's trading with multi-billion dollars. So this is a live example which he shared with me. He said that if I were not take that decision, then I would have thought, okay, market is not for me, and I would have quit trading and I would have moved on to some other trading profession. But I know it is something that anybody could work on it as long as they are really disciplined enough. So trading strategies or becoming successful is all about being disciplined. So when someone says trading psychology is so much important, it is nothing but trading psychology is all about knowing yourself. So the more you know about yourself, the more you know, explore about yourself, which kind of systems is suitable for me, whether positional is suitable for me, whether intraday is suitable for me, whether option selling is suitable for me or option buying is suitable for me. So you need to figure that out. So instead of directly looking for, okay, which strategy is giving higher returns, you need to ask yourself, which strategy will have a higher probability of me sticking to that same strategy for a prolonged period of time. So once you find that, then definitely, in the long run, you will always be able to stick to that strategy. And once you become disciplined enough, and all rest of the things becomes much easier. So that is what is really important with respect to algo trading. So this is what I wanted to convey in this video. So I hope this session is helpful. And if you guys have any questions, please post it in the comment section.